Though trade-dependent Singapore is expected to experience a soft growth over the next 18 months as the global economy continues to get frazzled by trade disputes such as the China-US trade war. But experts say that some economic data, such as the latest manufacturing numbers, are showing signs of a possible pickup in the economy.
Singapore's economic growth over the past few quarters has been weighed down by global uncertainties. The economy grew by 1.1% in the first quarter of this year, but that figure fell to 0.1% in the second and third quarters. Overall, for 2019, Singapore's central bank says that GDP growth is expected to come in at about 0.5%. That's about 1/6 of the 3.1% growth last year. While the numbers may seem bleak, economists are saying that there are signs of improvement and Singapore is unlikely to fall into a recession. For example, September's manufacturing output recorded a 0.1% uptick, rebounding from the 6.4% decline in August. One economist says the overall climate is expected to remain challenging until at least the middle of next year. And while this means a softening labour market, workers in Singapore should not be too worried.
Whenever there's a recession, usually the employers try to hold on to workers first. Retrenchment is usually the last resort. And essentially this is what we are seeing today as well. Some of the companies are struggling, but we are not seeing mass retrenchment yet. I think companies are being very responsible and they're trying to hold on to the jobs, the headcounts, for as long as possible. And I think this is actually a very positive sign.
While workers can expect to be spared the brunt of Singapore's economic slowdown for now, wage growth is still likely to come below expectations. This would also result in consumers tightening their purse strings.
Because the uncertainty still persists, so people are holding back on spending. We see that in the retail sales numbers, which have been negative for this year. During periods of uncertainty, you tend not to purchase any big items.
Mr. Seah adds that the Singapore government could look to fiscal policy to boost the economy, like switching to a zero appreciation monetary policy for the Singapore dollar. But the government will need to balance between meeting short-term needs and sustaining a longer-term policy response to cope with the changing economic conditions.
In the same review, MAS also downgraded growth projections for the global economy for this year and next year. Global growth is now expected to come in at 3.6% for 2019 and remain at the same pace in 2020, which is a step down from its earlier prediction of 3.9% for both years.
The central bank says global growth has lost momentum, dragged down in part by the China-US trade tensions. In particular, China's economic growth has continued to moderate. The Chinese government has been handing out government stimulus to boost its economic growth, but its high debt levels is putting it in a pickle, as one economist explains.
Total debt to GDP ratio is above 300%, right? And the government has been trying to deleverage, but yet at the same time have to stimulate growth. This is a very delicate, policy dilemma. In past episodes, whenever they ease monetary policy aggressively or stimulate the economy aggressively, what happens is that debt ratio shoot through the roof, right? And therefore, they have to manage that.
The global economy is currently facing a downturn in the electronics cycle, and if the trade war between China and the US worsens, it will drag the industry down together with it.
Given that a lot of the products which come under the December tariffs are consumer electronics, and that will probably have an impact on the electronics recovery story. If the tariffs go up, the down cycle will likely continue. The hopeful case is that they decide to suspend those tariffs, and then we will see a gradual recovery in the electronic cycle.